Our speaker this morning on multifamily will be Bob Kaplan. Bob's a principal at Picor Commercial Real Estate Services here in Tucson. He specializes in multifamily properties. He's been in Tucson since 1996, and he's been in commercial real estate brokerage for 12 years. Bob?
Thank you all. I'm just going to speak real quick about what's going on with the operating environment and then the investment environment for multifamily. As you heard from Tanner and as you've heard from the home builders, the whole housing sector is doing much better. There's an amazing ability for households to contract and then expand when recessions happen. People move in, people double up. I had a property manager once during the depths of recession say that she thinks she had tenants that were coupling. She two people sleeping in the same bed, and then they were decoupling. So it's growing, things are good. We are behind many markets here in Tucson, being a tertiary market, being an area that's had a hard time creating jobs. We are way behind Phoenix's and Denver's and Austin's and San Antonio's in our recovery, and also in our housing recovery and our apartment recovery. We still have vacancy citywide around 9.5%. It's improved slightly over the past year. I think we've absorbed about 1,000 units, which is not great, but okay. And then on the rental side, we're slightly improving. Rents are maybe up $2 a square foot to like $632 average per unit. But what's also happening is concessions are slightly wearing down. They're giving away less. And owners are also finding other ways to increase income through raising RUBS, which is utility reimbursements, and other little things like that, a little bit larger non-refundable deposit and those sorts of things. So it's gradually getting better very slowly. The A market is much, much stronger than the C market. So far, the A market has been able to absorb the new construction pretty nicely. As Tanner said, they've rented up well. They haven't been able to increase pricing, but they've rented well. Citywide, the A market's probably 7.7% vacant, that according to real data, whereas the C market, particularly in lower income areas, could be 12 or 13% vacant. Rents in A properties have now bounced back above pre-recession areas levels, and your rent for a C property down on Golf Links or 29th Street or South Tucson is still below pre-recession levels. So that's sort of the bifurcating of the market that we're seeing. The sales environment is very strong. Very cheap debt has made cap rates come way down. A lot of capital out there chasing deals. Again, we're a tertiary market. People are coming here for yield that they can't get in those secondary and primary markets, Denver, Phoenix, San Antonio, et cetera, et cetera. So that's driving money here. They can't get the yields going in that they want to or were getting a year ago or 2 years ago in Phoenix. That would be looking for cash-on-cash returns around 7 or 8% for a B property built in the mid-'80s, et cetera. This is for a 100, 200, 300 unit property. What does that create in cap rate? A 6.25 cap rate with 4% debt gives you 7.5% cash-on-cash going in, so that's kind of where we're at, 6.5. Cap rate for an A, B type property. A C property would be 50 to 150 basis points higher. Throw in a boiler chiller system, you're another 50 basis points higher, maybe 100 basis points higher. Much, much less demand for C properties. People got burned on those during the recession, and they're saying they're not going to make those mistakes again. So there's much less investor interest for a property on Valencia than there is on Fort Lowell or Grant or whatnot. We have had a very slow first quarter. A lot of deals were sucked forward into fourth quarter of 12 because of the tax law changes. Wasn't a lot of sales activity in the first quarter, but now it's quite busy. And I suspect we'll see a busy year, probably approaching the same level of volume that we had last year. We have, like I said, we have very strong investor demand. We recently put 2 deals in escrow. We had 11 offers on both of them and did a best and final on both of them. And one of them was only a $1.4 million, $1.3 million deal. That sector of the market had been much, much slower and quieter and now there's a lot of demand there. There's demand now also for stabilized properties instead of just value add. 2-3 years ago, everybody wanted value add, they wanted distress, they wanted a property that they could really turn around. But there's also good interest for stabilized properties. Again, investors looking for yield. That's the situation. It's a good year, good times. Hopefully it'll stay around for a while.